Trump's new reciprocal tariffs aren't just about trade. They could be the tipping point for economic disaster, and we're about to reveal the shocking reason behind it all. Stay tuned. I'm your host, Steve Metre, and thanks for joining me today. In our show today, alarm bells are ringing across boardrooms as a worst-case scenario for American businesses is unfolding, putting our economy at risk, all while Trump's tariffs may be the final trigger for a massive collapse. Get ready for the full story. Plus, amid all the tariff-induced chaos in the markets, our tariff-beating trade is shining bright, surging to new heights and putting serious cash in our subscribers' pockets. Stay tuned to the end to discover how you too can cash in big. Now, let's head over to Bloomberg, where we picked today's story up with a headline: as Trump moves to impose reciprocal tariffs, but not right away. And there's a good reason for this, because when we start looking at the underlying fundamentals of the U.S. economy, we've been talking about how it's going the wrong direction, and that there's serious issues here that tariffs could push the U.S. economy and the global economy right over the edge into a synchronized recession. President Trump knows this, which is why he perhaps is backing off a little bit. I've decided, for purposes of fairness, that I will charge a reciprocal tariff, meaning whatever countries charge us, we're going to charge them. And in almost all cases, they're charging us vastly more than we charge them. But those days are over. But they're not over just yet, because these tariffs aren't going into place right away, because there's serious problems in the U.S. economy right now, and starting at the forefront with what's going on with corporate America. Wait till I reveal to you what's really going on and why it's telling us that we're headed right into a recession, and that these tariffs could be the tipping point if enacted. Trump told reporters that he would enact import taxes on cars, semiconductors, and pharmaceuticals in addition to reciprocal tariffs, and this is all in a bid to bring jobs back home, put them on American shores, because what we're seeing in the labor market right now is outright terrifying. But there's a big catalyst for why we're seeing the labor market weaken, and it's everything to do with what's going on in corporate America. But whatever happens, Trump's brinkmanship has injected uncertainty into the global economy, with businesses and consumers waiting to see how Trump proceeds on decision that could disrupt the U.S.'s trade relationships with the rest of the world. But what the real issue here is that tariffs threaten to send prices higher. And what I'm going to show you is going on in corporate America. The last thing we need is higher prices, not just for companies, but for consumers as well, because what is coming is outright terrifying. But something that should be surging higher, that is your trading account. And check out our big trade on the books right now. This is large gold miners. We put it back on January 10th, now up as of yesterday's close of business, 14.92%. And you hear about buying before the big money and selling before the big money gets out. Well, the big money is now traded by machines, and I've reverse engineered the formula behind how these machines trade the markets. We now make that available to you in our report each and every day. Stay tuned to the end of the show, or grab those links in the description below. Be sure to hit that 30-day free trial, because U.S. wholesale inflation tops estimates on food and energy. And inflation here from the wholesale level is all about what's going on in corporate America. And this is going to make perfect sense, because as we see prices at the wholesale level go higher, it impacts, of course, consumers. But that's not the entire story. Let's take a deeper look here, because producer prices rose 0.4% in January following an upward revision, but we knew this was coming. And that 0.5% increase in December was a big hit to consumers, because what we're hearing from manufacturers is they're passing these costs on to consumers because they have no choice. They're saying, look, our input prices are rising, and that means our output prices are going to continue to increase until something changes. And right now, there's no sign that input prices are about to abate. Compared with a year ago, the PPI increased 3.5%, suggesting that inflation is likely to surge higher. And we've been talking about this for months, because when we look at the producer price index by commodity in terms of final demand in red against the consumer price index in blue, both shown on a year-over-year rate change, we have an issue that producer prices by final demand, as you can clearly see in red, were rising against consumer prices that were decelerating, and something had to give. And what we said, it was likely we're going to see inflation head higher, and sure enough, and I believe it's going to continue heading higher. And the evidence is very clear, because what we see from producers are saying their prices are going up, and they have absolutely no choice to pass it on to consumers, because there's something serious going on inside corporate America that they're not talking about, but I'm going to show you here in a little bit. The data on wholesale prices follows a surprising consumer price index report on Wednesday that showed underlying inflation at the start of the year was the highest since March. And that's the thing, it wasn't surprising to us because we knew about the wholesale inflation trend. We had to eventually pass into consumer prices. We heard that from businesses and manufacturers, and here we are seeing it. So the surprise, well, maybe to the media, but not to us. The figures sharply reduce odds that the Fed policymakers will lower interest rates more than once in 2025, with some economists expecting no rate cuts due to the fallout from higher duties on imported goods. But what we do know, what we've talked about in yesterday's show, is the Fed really doesn't follow inflation. If you look at monetary policy and inflation, you don't see any sort of correlation. It's just an excuse. And what we know right now is the Fed doesn't want to cut rates, so they're using the one thing to give them that excuse, and that is, well, inflation looks like it's going to go higher, so we can't cut rates, and they've got the market convinced of that, even though in the past, we've seen the Fed cut into higher inflation many times, well, particularly right before a recession. But let's talk about what's going on really behind the scenes with businesses, and that has everything to do with profits and profit margins, and we're going to talk about how this impacts the U.S. economy in the worst possible way, because when we look at consumer prices still in blue against corporate profits after tax, that's shown in red, both on a year-over-year rate change, I want you to see something interesting that starts to happen in the late 1980s. And it's not just that inflation rises, because we know that happens, but look what happens to corporate profits after tax. They start to decelerate, and next thing you know, we go right into a recession. And if we move forward, what happens to around 1999? Inflation takes off again, but look what happens to corporate profits. They don't go up. And this is a dangerous sign, because what do equity investors tell us? That inflation's great for stocks. It means stock prices are going to go higher. Well, there's a problem. Higher inflation doesn't always lead to higher stock prices, and the reason we're seeing that is right here on this chart, because once again that happens when we see inflation surge higher right before the global financial crisis. What happens? Corporate profits are plunging, and now what are we facing? A possibility that inflation is going to continue rising for several months, but what's happening with corporate profits right now? They're starting to roll over, and this is a huge problem for corporate America. At a time we know the Trump administration wants them to hire people, give them higher wages, put them to work, and spend money into the real economy, which is something we're going to desperately need, particularly if tariffs come into place, because what is that telling us is going to happen to consumer prices? They're going to go up even more. And if there's an issue here that we should really be focused on, it's the fact that if you see a trend of corporate profits decelerating against rising inflation, it tells you something very serious is coming, and soon. Meanwhile, the PPI report showed services prices rose 0.3%. The BLS said a third of the increase was accounted for by a surge in the cost of travel or accommodation. But that wasn't the only issue the BLS noted. Portfolio management services costs also rose for the second month, but that tends to happen when the stock market goes up. The real issue here that we're seeing underneath all of this is, what did the services sector tell us in the recent reports? That they were forced to give out higher wage increases, and they had no choice but to pass it on to consumers. That's exactly what we're seeing in this report now, that higher wages are indeed passing through. But what does this mean for the real economy? Why is this such a serious issue? Well, we're going to keep the consumer price index in blue against corporate profits after tax in red, but now I'm going to overlay continued unemployment claims, because I want you to see something. When we go back to the late 1980s and we start to see corporate profits fall below inflation, there's a trend of rising unemployment. And why does this start to happen? Why do people lose their job and then get stuck on the unemployment line? It's because all of a sudden companies are trying to defend their bottom line. They're trying to defend their profit margins, and next thing you know, there's only one answer left when they cut every expense they can. They have to cut heads. And take a look at what's happened in late 1999 was continued claims bottomed and then took off. We saw it happen once again in 2007, where this event happened right before the global financial crisis, and surging continued claims sent us right into a massive recession. And now look, everybody believes that the labor market's going to turn around, that everything's going to be okay, and there's going to be a surge of hiring. But this issue where we see that corporate profits are rolling over and the inflation is likely to head higher, that tells us that there is one last place for companies to go to cut expenses, and that is the labor force. This is the worst possible scenario now. So you start to put the pieces together, and what do you see? That rising inflation due to tariffs could be a huge problem, because it means that companies can't pass these costs on to their profit line. And that's the issue here, that they're going to be forced to lay people off, because what do we already know about consumers? They're telling us they cannot afford higher prices. So what if prices go up even more? That means less demand, less employees, and right into recession. You can see this happens each and every time. A separate report released on Thursday by the labor market showed initial claims for U.S. unemployment benefits declined last week by 7,000 to 213,000, which still remains a rather historically low number. Continuing claims, a proxy for the number of people receiving benefits, declined to 1.85 million. Now keep in mind that these are the seasonally adjusted numbers. Now the problem is the non-seasonally adjusted numbers aren't dropping as quick, and it was something we talked about weeks ago absolutely needed to happen. Let's take a look at the non-seasonally adjusted numbers. Here we see initial claims at 231,000, still a relatively low number historically, but look at continued claims. They're now sitting at around 2.2 million. Now granted, that's down 58,000, which is huge, but remember that 2 million mark was a very serious number for us, because what it tells us is 2 million people that have less income, and that means they're spending less money on the discretionary side of the economy. And keep in mind, if tariffs hit and they come out and prices jump, that means these people are going to afford even less. So you're going to see demand drop in a big way. And we're already seeing signs that lack of demand is having a huge impact on the labor market, and we could see a major unwind coming even sooner than most people believe. A struggling fabric maker and craft seller, Joanne, now plans to close about 500 stores across the U.S., or more than half of its current nationwide footprint. And that would be thousands of jobs lost, but they're not the only ones. Let's take a look at what's going on in the oil industry. As Chevron said, they're going to cut their workforce by up to 20%, and that could affect 8,000 employees worldwide, which is a problem because half of those are located here in the U.S. and it's going to start this year. So we're seeing signs that when profit margins start to get impacted, companies are doing the unthinkable. They're closing stores, and this is something we didn't see going into other prior crises, and yet now they're closing stores ahead of time. We're seeing the energy sector, which is hard to believe, layoff, but they're not the only ones flagging a warning sign here, as Kellogg beats on profit despite challenging environment. And look what Kellogg's had to say. They said their revenue would decline about 1% this year. Keep in mind that's not inflation adjusted, but here's the big issue. Sales in the fourth quarter were down 1.8% in dollars and 5.6% in volume, indicating that higher prices are not compensating for consumers buying less. And of course, that means that eventually their revenue is going to drop, their earnings are going to drop, their profits are going to drop, and so too are the number of employees on Kellogg's payroll. But look at this, L'Oreal sales disappoint as Chinese demand remains weak. Of course, we know what that means. They're eventually going to lay people off. And while sales rose 2.5% on a comparable basis, the issue is North America only grew at 1.4%. When you factor inflation, that was a negative number. And their rival, Estee Lauder, announced plans to cut as many as 7,000 jobs after saying sales in the current quarter will slide by up to 12% on the underperformance of its duty-free business in Asia. So we continue to hear about companies laying people off and not hiring, and that's a big problem, because what it means is when people lose their job and they go on unemployment, their opportunity to re-enter the workforce is rather small, and next thing you know, you get a snowball effect of people on unemployment, and it gets out of control. And yet the president's decision not to implement tariffs right away could be seen as an opening bid for negotiation, following the same strategies already used to extract concessions from Mexico, Canada, and Colombia, rather than a signal he's committed to following through. And that could be the real issue here, as we started the show by saying there's major problems going on in corporate America, and President Trump realizes this. So perhaps the reason he did not put the tariffs on, but told the government to start doing the research and figure out what we should do, was to give him a chance to negotiate, to perhaps come up with something to keep these tariffs in place. because as you're seeing, as long as we continue to see a rise in producer prices and a decrease in overall profit margins, it means there's going to be a massive amount of layoffs coming here in the near-term future unless the U.S. economy turns around and fast. But something that should be turning around in big time is your trading account, because our subscribers jumped big on this trade for gold miners. Here you can see back on January 10th, we told them to buy it open. Here's your upside target. And now they're up nearly 15% and looking for even bigger returns. Now, how do we do this? Because everybody tells you, if you want to make money in the markets, you got to buy before the big players and you got to sell before they get out. The problem is the big players are all machines, but this is to your advantage because they trade based on formulas, and I've reversed engineered them. And let's check this out, because this is right where we told our subscribers to buy, and here's where they're shooting up even more today. And every day we run a report against the broad equity, currency, commodity, and bond markets to give us the edge to find out how those machines are positioned and when it's time to buy. Here you can see back on January 10th, we said this is the time to buy GDX. I gave our subscribers all the signals they needed. You get the daily report, but here's the best part. You don't have to read it, because in the box below the report, I tell you which trades I think you should take. We back tested it so we know it works. We give you risk control levels, full tracking of trades and returns. Plus, I disclose how I'm trading my own personal account with my reports. And the best part of all, because we're so confident that you will make money trading a report, we're not going to charge you for the first month. You get a 30-day free trial. Be sure to use the links in the description below and grab those coupon codes. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.